Welcome to TheoTrade. This is Don Kaufman. Here we are. It's February 11th, 2017, doing the TheoTrade weekend update. First and foremost, we're going to take a look at the SPX, what to do in a market that's doing much of nothing. Now, wherever you look in the financial media, right here, right now, what are they talking about? Markets, all-time highs, exploding higher. The first thing I want to kind of counter with a little bit, did the markets really do anything unexpected, kind of quote unquote? And one of the things, of course, that we look at extensively in the markets is what are the option markets anticipating risk and movement to ultimately be. So that's one of the things we're going to kick this off with. But as I said, for those of you that trade some stock, great, a couple of stocks, migrated a little higher, some all-time highs out there in the market. But for those of you that trade options, again, I say, what to do in a market that's doing absolutely nothing? Well, that references implied volatility. So we're seeing some of the lowest implied volatilities pretty much across the board that you can imagine. I mean, you got to start going back. In my mind, I start going back to 2007 to have seen implied volatility this ridiculously low for such a sustained period of time. In fact, it reminds me directly of like January and February of 2007. But neither here nor there. Let's kick this off with what the markets were really anticipating. Because again, the financial media was jumping on this, exploding to all-time new highs. And did the markets really explode? Well, the SPX closed the week, right, on Friday at 2316. But, okay, what did we do the entire week? So for that, I'll digress for just a moment before we really give a forward look. We always want to look back and see, did the markets do anything that was not being anticipated? Okay, so bear with me as I take you through this, because first and foremost, this happens to be, all right, literally last Sunday. Okay, so I actually changed the date, and what you're looking at right now is on the thinkorswim software, we have what they call Think Back. And I just went back precisely a week. So I looked, okay, I took, this Friday's close and this Friday's close over here. So, of course, February 10th. And I just jumped back exactly a week to the last trading day over here was February, 3rd. And what I wanted you to see is where the market closed last week was 22.97. And here we are. Again, this is a forward look. All right. The market was anticipating right around a 22-point move. Okay, so where did we end up? Well, for that, all I want you to do is take the 22 and just add it. Clearly, we went up this week, right? This is plus or minus 22, but let's add it in this particular case. That would take us to what? Roughly 23, okay, 19. So we were expected to move within a 22-point range. Did we stay within the 22-point range? We didn't just stay in it. We pretty much tagged it to a T. I mean, look at this. The high of the day was roughly 23.19. So respect expected move. Nothing unusual happened this week. We stayed inside of the expected move. In fact, okay, we're right at the cusp of the expected move. And for those of you that do remember, this is why we just did a class specifically on expected move and building trades around the expected move back in December. And I always like to reiterate that because this is several weeks in a row. For the most part, we don't just stay inside the expected move. We're actually moving right to the edge of the expected move out there. Efficiency of the marketplace, okay, once again, kind of rules the day. So the place I want to start is the markets didn't do anything unusual, anything out of the ordinary. That was a backward look at the markets. Now, let's look at the markets forward, okay? Meaning that let's project what the expected move is going to be this week. And it's a little bit more complicated here. So I go into the SPX and I opened up to a full screen over here and I wanted to show you. Here's the Monday expiration, the Wednesday expiration, but you got a little bit of an issue here this week. And the issue is the monthly expiration in the SPX is coming. Now the monthly expiration, it's totally confusing, right? The last day you can trade it is Thursday, but it goes off Friday, opening print, yada, yada, yada. You don't trust the monthly expiration. So this particular week, rather than looking at the SPX, okay, I'm actually going to divert our attention over to the spiders, because the spiders will give us a full, including Friday expiration. And what is the risk that's anticipated this week? You're going to love it. You're going to love it. it's basically $2.35, which translates into the SPX to about what? $23. Now remember, the previous week we had $22 of expected move. This week we have about $23 of expected move. So what are we saying? Well, much of the same. Okay, and when you think about this $23 of expected move, that $23 of expected move is in relation to the SPX. Okay, so if you go over to a chart, kind of know where we're going to be at. You take wherever we are right now, this 23.16. Well, add $23, subtract $23. And for the most part, you can even draw that if if it does it for you, just draw it on the chart over here and give yourself, okay, this, $23 window in this neighborhood, and that's roughly, okay, 5 days from now where we're supposed to be. Now, can we exceed the expectations? Absolutely. But lately, when we've exceeded expected move, so for example, if this happens to be the expected move for the week, okay, and the options market is really forcing us to stay inside of this expected move. Why? Because there's hedging activity. Every time we go up a little bit too high, what happens? Okay, they turn around, sell, sell, sell. Okay, they're hedging to the edges of the expected move, which is actually driving markets to the edge of the expected move. However, every time lately that we've broken through the expected move, we haven't done like 2 times the expected move. And by the way, this week, 2 times the expected move be like a $46 move. We've been doing like 3 times the expected move. And all of a sudden you're like 23 times 3, and you're like, yeah, that's a really big move. All right, you start getting wild 60 and 70 point moves. And that's what we've seen much of lately, meaning that, look what happens. Absolutely nothing, absolutely nothing, absolutely nothing. Here, we're still inside the expected move. Out here, this is like a 3 deviation move, followed by another, 3 deviation move within, again, a very, very short period of time. So throughout, and again, if I back up for the last 3 years, I will remind you, this is exactly the activity we've been seeing for 3 years. What's that? Absolutely nothing. We stay inside of the expected move. Then we see these 3 deviation moves, okay, followed by another 3 or 4 deviation move. We do nothing for a period of time, followed by a 3 deviation move, followed by a 3 deviation move. They're insane, okay? And one of the things that I have been just a huge advocate now is not selling options premium. Now, the previous 15 years of my career, okay, I've been a huge premium seller. Right now, I'm sitting back and I'm like, oh, I wouldn't sell premium in this. And that's where I really want to take us in this conversation, is that, what to do in a market that's doing absolutely nothing. So for those of you, listen, maybe you don't trade the SPX. That's fine, okay? But if you go look under this option statistics, okay, there's this thing called current IV percentile. That's the implied volatility ranking for the most part. What it says, okay, is over the last 52 weeks, where has implied volatility been in the SPX? Well, over a 52-week period of time, it goes up, it goes down, it goes down, it goes up, it goes down, it goes, it's all over the place. But right now, it's ranked, okay, in the 6th, for instance, 6th percentile, which means we're at one of the lowest occurrences of implied volatility, okay, regarding the SPX anytime in the last 52 weeks, okay? But then go look at some other products, right? What do you mean go look at some other products? Like, all right, I'll go over to the financial product over here. Oh, well, that's an 11 ranking. I go over to Google. All right, I'm pulling up some equities. Okay, Google's a very, very low implied volatility ranking. Let's go look at, the Facebook. Oh, Facebook is almost 30%. Okay, we haven't seen anything over 50% IV, percentile. We'll go to Amazon. Amazon's a crazy animal. No, it's not. Okay, where else do you want to go? You want to go to a bank stock like Goldman Sachs? Sure, absolute rock bottom over here. XLE, hey, listen, XLE, the ranking, 9%. Have you not looked at a chart on the XLE? Okay, pretty volatile out there. Where can you even go to find decent implied volatility? Oh, let's go to the IWM, the Russell, okay, which is truly Mr. Toad's wild ride lately. The Russell, it's got 20% ranking. Every product we've looked at, for the most part, okay, is well below the 50th percentile. And I'll give you some products that have been getting absolutely slaughtered lately, and they're still inherently low. What's a product that's been absolutely just hammered lately? And I'm talking about big names. Like, listen, I could go over and I could find a few smaller stocks here that have just been annihilated. Okay, don't make me have to go to them, GoPro. Don't make me have to go to Under Armour. But listen, go look at something like Target. Okay, here's a stock that's well, again, if you look over 9 months, it's pretty much just off its 9-month low, and yet even Target getting smacked is only a 41 ranking in terms of implied volatility, which to me, that scares me. All right. And what scares me about it is people are going to go out here and they're going to try to bottom fish stocks that they think are getting beaten up. Ain't getting beaten up according to implied volatility. You look back on a 3-year chart, and this beating over here is almost as bad as it gets, and yet it doesn't even get over a 50% ranking in implied volatility. What I'm saying by this, there isn't any fear. Okay, traders, you need to feel the fear, and if you don't know what that means, okay, then you better allocate very, very lightly until you figure it out. And what feeling the fear is, when you look at the screen, you're like, I don't know if I'm going to make it. It's when the market ultimately, okay, has implied volatilities really start to explode over there. And frankly speaking, the last time that anybody felt the fear, you got to start going back to, all right, Brexit, it was a brief and fleeting moment. Okay, the election, you had an hour of a sleepless night before we actually exploded higher over there. I mean, you got to go all the way back to like August of 2015, the last time that somebody really felt the fear in the marketplace. However, for those of us that trade a lot of options, this isn't good. I mean, let's go over and let's look at the spiders for a second. Okay, and not so much of a spider chart. What do the spiders do? They went up. Okay, there is no overbought or oversold anymore. It doesn't matter. Quantitative easing changed the entire notion of overbought or oversold. I can look at every indicator that you want. I think we're overbought. Yeah, we might be overbought since, I don't know, about 2010, but neither here nor there. It doesn't matter, right? You just continue to grind higher. And yes, I am short the markets. But again, more importantly, like if you're going to trade some options in here, what to do, okay? There's limited capability, especially on the sell side. And let me show you why. So I'm going to open up some options, got about 32 days remaining to expiration. Okay. And by the way, I could open up, 27-day options. We can open up 32-day options. We can open up a standard expiration of 34 days. You're going to see the same thing through and through. And I'm going to open up every single option in the chain because I want to elaborate upon this for just a moment. If you look at out-of-the-money puts, again, I'll use the spiders because the SPX, for the most part, it scares people to death. But here's the spiders with 34 days remaining. It's the March options. I want you to look at the out-of-the-money puts. Go way out of the money. Crazy way out of the money, right? Look at this stuff. It's like 11 cents, but it's got like 24 implied volatility. Even if we scroll a little closer, okay, and what we're doing right now is we're looking at the individual options implied volatility. We're not looking at this average implied volatility, which is 12%. I want you to see as you go out of the money. Here's the 212 strike. I mean, the 212 strike, come on, it's $20 out of the money. The implied volatility is roughly 17%. Then, okay, cruise over to the out of the money calls. And if you start cruising over to the out of the money calls, right, what do you notice immediately? There's no juice out there. When I say there's no juice, there's no premium. Look, the implied volatility is like 8%. So when you start comparing the out-of-the-money puts to the out-of-the-money calls, the puts are literally carrying over double the implied volatility than the calls. What this is called skew. And the skew makes it incredibly challenging, okay, to build, okay, trades where you sell premium. And I'll show you why. If you go out there and you're going to sell, okay, some spread. When I say you're going to sell a spread, somebody goes out there and they want to sell an out-of-the-money spread and they go sell vertical, okay? Make it just a $2 wide vertical. Let's not get crazy, all right? So let's do like the 26.24 for about, look at this, 32 cents. I mean, would you sell a $2 wide spread for 32 cents? And the reason it's trading for 32 cents is the option we're selling, which in this case is the 26, okay? The 226, I should say, the 26 puts. The option you're buying, which is the 24 puts, right, the 224 puts, the implied volatility you're selling is an 11%, but then you're turning around and buying, okay, a 12.3%. The skew is going against you. Now, that doesn't sound like a lot, like, oh, I'm selling an 11% and buying a 12%. Okay, but it's huge because look at the impact. You're collecting what? Like a whopping 32 cents, and it's a $2 wide spread, which means roughly you got like what? $1.68 a risk? Yuck. You got $1.68 a risk, 34 days left. And this option, I mean, these things are only what? $6 out of the money? Not even. It's pretty scary. All right, so there's no juice to sell on the put side. And yes, I'm doing this in the spiders, but I'll reiterate this. I don't care how many stocks you want to look at. You can go look at stuff that's just being beaten to death. Go look at like Whole Foods and it too. Well, not great liquidity in there, okay? But couldn't happen to a better store. Anyway, I mean, you can look at any product you want, and they're going to have similar skews to this. So it's like next to impossible right now to want to sell a call spread. All right, too. So I look at the put spread, and you collect 30 cents. But then you look at the call spreads. Do you really want to sell something with an 8% implied volatility? Look at this. All right, I sell the 235s. For instance, buy the 237s. Hey, look, at least on this $2 wide spread, I collect a little bit more. But I'm selling the 235s. All right, and those 235s, they're where? Okay, they're only what? Listen, this thing can move in the next, 34 days? It's supposed to be able to move $7. You think that's not within striking distance? I'm only like $3-4 out of the money here. I'm clearly going to get run over with this one. So you're not selling call spreads and you're not selling put spreads. What can you do? Right now, I think you got to be on the buy side of this market. And again, it pains me to say that. 15 years I've been talking about selling premium. Now I'm like, no, you got to be on the buy side. But I've been talking about this a lot. This isn't like, yesterday. Got to be on the buy side. If you want to take a shot, like if you think markets are really going to tank, take your shot. There couldn't be a better time to be a buyer of premium. But I'm not telling you, don't go out and just buy puts. You buy puts, the decay is going to kill you. You got to offset your risk by using some type of a spread. Okay? If you look at it, the at the money spreads right now, look where we are. We're 231.51. At the money spreads, like if I set up a spread right now, and here is let's say we bought the 233 puts and sold the 230 puts. Now, bear with me here for a second. This is a $3 wide spread. Okay? This happens to be right there. It's a $3 wide spread, of which you're paying, less than $1.50 for. So, and the underlying is at where? 231.50. So for the most part, you're paying less than what's termed intrinsic value for this. Now, if you pay $1.50 for a spread that can only be worth $3, the most you can make on it is $1.50. Okay, but recognize you're not going to have some extraordinary risk over here. You know what the risk is. You paid for it up front over there. That's the simple in-out spread. Okay, even at this time, like if you want to take downside shots in the market, like I don't really suggest going out and selling a bunch of futures contracts and praying we go down. Or, hey, you could just go out and short stock and short enough stock to the point your hand hurts, from pressing the button so many times. Hey, that's all well and good, unless, of course, we go up. But if you want to take a definitive or educated shot and you think the markets are going to sell off, you could even use an out-of-the-money put spread. Buy we were looking again. Selling the spread looked terrible. Well, you could buy it. I mean, literally, why not? Why not buy a spread instead of turning around and, again, selling the spreads out there? And that is where I think some of our focus has to be. Lately, again, I've talked a little bit about the buy side, okay? And I'll continue, again, to kind of reiterate just that in some of the sessions to come over here, that the buy side is the place you want to be. We've talked about just recently buying straddles or strangles on a weekly basis. Now we're talking about, buying, if you will, out of the money spreads. But hey, if you want to be able to take advantage of that downside opportunity, that could be the most viable alternative out there. Now, on top of it, throughout the course of this week, a couple things I want you to keep an eye on. The XLE, which is your energy sector, got whacked, rallied a little bit, sold off, kind of faded as the week progressed. Also take a look at, of course, the retail sector, which rallied during the week, and it faded hard on Friday. Those are the two sectors you want to keep a definitive eye on. In addition to it, eyes, of course, on the financials. Thanks, everybody, for joining us here at TheoTrade. Again, think about it over the weekend, be it on the buy side opportunity. Have a great weekend. Bye-bye.